Our background music is fantastic. Let's get. I like the thumbnail that we have on here. You're a little close, Charlie. You're a little close.
I was sorry. I was doing some work. I wasn't paying attention. I don't even have myself on the screen.
Alrighty, well, maybe we should get going. Do you guys want to get going, or should we chill out for a little while longer? I know,
I'm good.
Robert,
I'm good with going.
You're super relaxed, though. Maybe you're too relaxed.
I'm good with going.
All right,
You know, when you gotta go, you gotta go.
Charlie, you ready to go?
And I am indeed.
All right, well, let's light the fuse on this Monday, March 3rd, kicking off the month. This is Wall Street Beats. I'm David Maris. We have Robert Marson. We have Charlie Peabody. We're going to talk computers. We're going to talk banks. We're going to talk hospitals. We're going to talk about drugs. What more can you get for a Monday? Drugs and hospitals. Sounds like one of our colleagues. Sounds like one of our colleagues' weekend.
Sounds like my weekend.
Yeah.
Well, let's start with you, Robert, with the great weekend. But let's talk a little bit about you. You wanted to talk about Dell this morning. I'm in the market for another computer. Should I be thinking about a Dell? What are you thinking about Dell?
Yeah, absolutely. So, Dell's had a long and very interesting history, and from time to time, it hits my buy screen when they're public. They were private for a bit in their history, and it did that last week. It did it a while ago, a few months ago as well, by plunging from a former high of 180 nearly down to 100. And when it was in the 160, 170, I would go to 100 in a profit-taking panic, which it went to 89.30 last fall, I think, or summer. And I didn't pull the trigger. It rallied up to 135 or 140. I think this time, maybe 150. I wasn't paying attention to it. I was mad I didn't buy it at 90. So it's down under 100 again today. It's 99 and change. Am I buying the stock today? No, but if it goes back under 90 or around 90, I will probably stick my toe in the water and buy a starter position. So I have the file on it. I started doing the research over the weekend, reading the conference calls, earnings reports, the analyst day transcript and slides, just doing the fundamental work that convinces me it's a decent buy at $90. They're on a February year, so February 26th, the estimate's $9. They did $8. They're growing their revenue 7-8%, which is for them $100 billion company, pretty solid. And it's down a lot. It's at 10 times earnings. It's kind of too cheap to be true in a 20 PE stock market. And they have a reasonable growth story. They have a couple of growth angles this time around. Obviously, Michael Dell went on CNBC over the summer, pumped the hell out of the stock as he sold it. So I don't know whether to feel, ill will towards him or, just, confusion to the people that chose to buy it at $180. Because when a CEO goes on national TV to pump a stock that's tripled in a year, you know he's writing a sell ticket behind that. You just know. So it's not anywhere near that today. The story is decent. The growth angles, Michael Dell was pitching AI, as everyone was in the crescendo of AI in the summer of last year. Dell, it's really not a growth company without AI. And with it, maybe it's a 3-4% revenue growth company. Their plan is to turn that into 8% earnings per share growth, to generate 100% of free cash flow from net income, and to pay 80% of that back to shareholders in the form of dividends and share repurchases. And for a technology stock, that's a very extremely generous, return of capital. Most technology companies don't return much capital at all to shareholders. Usually, they don't pay dividends, and their stock prices are too expensive for them to want to repurchase shares. So when tech businesses get to be cash flow positive, a lot of the time, unless you're Facebook or Google or companies like that, where you generate $1 gazillion, you got nothing better to do than buybacks. These guys tend not to generate cash. So Dell is very shareholder friendly in that respect. So the AI story again is driving their infrastructure solutions group with servers and racks. They're into liquid cooling and all kinds of and into storage for AI and general storage. That's their really high end corporate products with decent margins in the traditional server and storage market. There is some competition in the AI server market, as evidenced by what's happened with Han Hai or Foxconn getting into the business and telling people they weren't going to generate great margins. They were willing to sacrifice margins. And when a Chinese company publicly says they're willing to sacrifice margins, that's not a very friendly competitive environment usually for the American companies who want reasonable returns for their shareholders. So that's an issue I'm concerned about. But so far, Dell hasn't said anything about profit margins being any worse than they were last couple of quarters as they started transitioning to the new product and lost some revenue growth. The Blackwell, I guess it is. So there's also a big corporate refresh coming up. Dell doesn't do a lot of commodity PCs for individuals. They're really 75% corporate, and then they do a high-end PC and gaming business. So they don't want to go after the low end for the desktop or the low end for the laptop market. So if corporate America upgrades because Microsoft's shutting down one of its older Windows platforms and corporations now haven't bought in 5 years, so they're due for a general upgrade cycle anyway. And if AI is an extra kicker for that, that could help goose it. So they're doing 7-8% revenue growth, which for Dell's been a good couple of years. It's forecasted to be that in 2026 as well. So I don't see why if they do $9 this year and $10 next year, we can't have a stock that's 150 this time next year. So it's probably got 50% upside over the course of a year. 15 PE would be a 25% discount to a 20 PE on the stock market. I don't see that as being an outrageously aggressive valuation target for the stock, assuming everything's clicking over the next year. So it just hit my screen again recently, and I'm circling it. I haven't yet pulled the trigger. I was kind of shooting for 90, not 99. So if it gets down into, and I consider 91.5 to be 90 in the big picture of things when you're looking at $170 price target. So I'll probably take a starter position. It can go to 90 in 3 bad days in the stock market. So I might not be on the show again before before I'm buying the stock. So it's
Yeah, no, it's down. It's down four. I just looking now. It's down 4%. $4 today. So you have another couple days before you're at your
couple
$90.
days and $90. $90 would be, I think, a decent place to stick your toe in the water and get to when you buy a 1% position, which is what I consider a starter position. You're not rooting for that thing to work, because if it works, I'm mad at myself. But you learn how a stock trades. When you watch it and you don't own it, it's different than when you watch it and you own it. When you own it because you watch it because you own it. So I'll probably try to get my position started first purchase around
So you
$90.
said you spent some time over the weekend looking at the transcripts and the K's and the Q's. When you were looking at the transcripts, what's like the number one or two things that you were looking for?
Well, it's not the best way to do it, but it saves a lot of time. You're looking for body language, which is why you want to actually, listen to the transcripts, right? You want to listen to the replays more than anything else. But you want to see how the company handles questions about issues and how confident they seem to be in achieving prior stated financial goals. That's what I really look for. There's a set of financial targets out there for most companies, and the question for me listening to this is, does the company seem to be signaling it's on track for those, whatever interim financial goals that they've stated by how they answer the questions? So, Silicon Motion has us. It's a recent purchase, I made very visibly here over the last couple months, and they have two or three items that need to be executed this year for them to hit this year's financial goals. So you're just want to zero in on two or three items that you think are key to them making their financial targets. So that's really what you're looking for. And again, when you listen to it, it's much better. When you listen to the replay or obviously the original play, it's better than reading the transcripts. But when I'm trying to get a feel for the company for the first time, I try to read as many as I can, as many reports as I can find on my Bloomberg, as many. If they have an analyst day where they do a lot of detailed presentation in the last year or two, I go back and look at the slides. Frequently, there might be 120 slides and 4 or 5 presentations, detailed presentations by senior management. I go through that just so I have a baseline of knowledge about the business. So, but on the earnings calls and the conference calls for earnings calls, it really is, are they hedging? Are they bringing up issues or concerns that they may not say, is going to cause a problem, but you'll learn that when they start to cite things, it's what you have to read between the lines. And, I've been doing this since 1982. So you figure out what a company really means when it says something else. So that's what you're looking for. That's a very good question, David.
Yeah, it's because I do the same thing. I listen, and the idea of forensic linguistics is important. It takes so long to learn when people are lying to you, and you have to hear it
I,
live. You have to see, and if you can see it in person, it's even better.
I like to use the word hedging. They're hedging. You know,
Yeah,
uh, I
and
mean,
you're right. You're right because a
I've been
lot of
lied
times
to. I've been lied to many times. So
yeah, I think you're right. They're usually not lying. They actually usually believe what they're
right,
saying. They just don't know their previous inconsistencies.
right.
So, well, let's turn now to a group that the managements never lie to you. Banks, big banks.
You know,
So, Charlie, let's talk
at the
about
risk,
what are you looking at in the banks? I know there's a conference coming up, and wanted to find out why should we what are we looking for?
if we have time, I'll give you an anecdotal story about management's lying in banking. But so tomorrow, Tuesday and Wednesday, there's a banking conference. And typically here, now that we've got 2 months under our belt at this banking conference, you'll get some sort of quantitative update on the first quarter fundamentals. So I thought I would preview some of the expectations ahead of that conference. And then on Thursday, when I'm back on, I'll tell you what they said. But Jen, if you can put up the first chart. So at a very high level, what I wanted to put in perspective is how banks and financials are expected to perform relative to the S&P 500. So the top half of the chart are revenues for the S&P 500, financials, which includes insurance companies, fintechs, credit cards, stocks, et cetera. And then the third line is the Portalis banks. That's the universe of large cap banks that I follow. So the JP Morgans, the Citigroups, et cetera. And the first observation is if you look at the first quarter year over year expectations for revenue growth, it's in the low to mid single digits, where banks are revenues and financial revenues are growing slower than the S&P 500. But if you look at the right-hand column for revenues, you can see that revenue growth over the course of this year is expected to accelerate. So we're going to start off on a weak note, but end on a strong note. Now, that's pretty typical of Wall Street analysts' forecasts. They always have sort of a hockey stick type of formation in the back half of the year. If you look at earnings, again, you can see that S&P earnings in the first quarter are supposed to grow much more robustly than that for financials or banks. But when you get to the full year, banks start to grow in bank earnings start to grow in line with the S&P 500. But what observation I would make about the revenues relative to the earnings is you can see that earnings are going to grow much more rapidly than revenues. And so that relationship implies that margins have to expand as the year progresses. And margins for the S&P 500 are running around 12.5%. The historical high is around 13%. So, if there is any sort of hiccup in the economy or related to interest rates or tariffs, this margin expansion that is going to create this second half hockey stick type of formation is going to be in trouble. And this is important because there's a Russian mathematician called Lupinov that introduced the chaos theory. And the chaos theory, very, very simply put, and it's complicated, states that uncertainty increases exponentially with time as chaos approaches, and thus forecasts become more and more meaningless. And I say that because when you look at a forecast like from NVIDIA, they're talking about a second half margin of 75%, but a first quarter margin of 71%. And so when you get into a period of uncertainty, that second half forecast has less impact on the stock price, whereas the 75% has less impact on the stock price. The 71% margin for the first quarter has much more impact. And that's what I think we're seeing in the bank stocks. So let me go to the next chart, Jen, which shows revenues. So here's the revenue picture. The top three quarters are the commercial banks, and the bottom one quarter are the investment banks. And the very first observation I make on the very, very far right-hand column is the year-over-year rate of growth of revenues for the banks and the investment banks. And the first observation I would make is that the revenue growth for the banks is around 2.6% in the first quarter, whereas for the investment banks, it's 8.6%. And the distinction there is net interest income, or what we call top line revenues, that's spread income, is supposed to shrink in the first quarter, whereas capital markets are supposed to be more robust. And so when you look at the price performance of banks, the commercial banks, particularly the regional banks, have underperformed the capital markets banks because the near-term forecast has more meaning than the second half recovery. If you look at the second half recovery for NII, it's quite robust, but the market is not placing a lot of emphasis or weight on that second half recovery. They're placing more emphasis on the first quarter. And NII in the first quarter is actually supposed to decline by a low single digit, 0 to 1 to 2%. But the forecast is for the second half to recover. It's just that the marketplace doesn't want to weight that very heavily right now. So that's what you're seeing in the revenue picture, and we'll get some update tomorrow and the next day from these regional banks that populate this conference as to whether that is still the case or whether things are coming in weaker or stronger. I would say at this point the potential surprise is for weaker because we have no loan growth. The yield curve is very flat. And as rates have come down, the ability to reinvest at higher rates has fallen. So if we do get surprises, and I don't know if we are or not, but if we do get surprises, I don't think they're going to be positive surprises. It could be, first quarter is tracking as is, and that's what, probably we're going to hear more often than not. But there could be one or two disappointments in the quarter. So let's go to earnings because that's the last thing that I want to mention. So this shows the far left-hand column are my estimates. The second column are the street estimates for the first quarter, and then I compare those against the fourth quarter of 24 and the first quarter of a year ago. And generally speaking, I would say that my estimates are below the street. There are one or two where I'm above the street. M&T Bank, I'm way above the street, and J.P. Morgan, I'm above the street. But as I said, since I'm below the street, I wouldn't be surprised with some negative surprises in the guidance that we get tomorrow. Again, I would just point out that the year-over-year growth rate for the investment banks is projected to be much stronger than that for the regional banks because of that difference between capital markets and net interest income. Let me make one. Yeah, go ahead.
I was
Sorry.
just going to ask you, as a second derivative, do you think if they do wholesale say, hey, listen, we're going to be a little bit light, or a few of the major banks say that, do you think that they're going to blame just the rate environment? Do you think they'll blame the weaker consumer or real estate? Is there something else that could be a play here that, no, they'll probably blame real estate, so be short the home builders as a play on that as well? Or what do you think?
I think they're going to blame tariffs, and that CEOs right now cannot make decisions. And that's part of this environment of uncertainty. You can forecast what you think the second half is going to be like, but in an environment of uncertainty, CEOs don't make strong, commitments. And so loan demand right now is very weak because they're not willing to go out and make capital expenditure projects. The M&A cycle has been put on hold. The aftermarket for IPOs were actually very strong in January, but the aftermarket price action has been very poor. And so the question is, does the buy side start to get cold feet about buying these IPOs if the secondary market activity is not good? So investment banking activity could be, disappointing. Trading, trading was very strong in January, but we had a trending market that, had a little bit of volatility. And as long as you know the direction of the market and have a little bit of volatility, that's really good for trading revenues. But when you get what I call bad volatility, which is where trading prices are gapping, at the open or somewhere during the course of the day because of a news announcement, you get whipsaw moves like we had Friday. That's very hard for market makers because they do carry inventory and they try to hedge it. But when you get whipsawed and you have gapping prices, that's hard to hedge. So February, I would say, has the potential to be less attractive on the trading front. And that's very important. Unfortunately, we're not going to get a lot of big, investment banks talking at the conference. It's mostly regional banks. But Citigroup will be talking, and they're going to provide some guidance with respect to trading, some guidance with respect to investment banking. And if it's disappointing, it's going to cause another sell-off in these capital market stocks.
All right. You said you had one other thing.
Yeah, it was just more about Citi. I'm actually, it's still my top pick, but I'm actually a little bit below the street in my earnings estimates for Citi. And so, the key is going to revolve around what they say on the capital markets, particularly trading and investment banking. So, I'm at $1.84. You can see on that table, the street's at $1.88. Not a big difference, but it's a slight difference. And if capital markets activities are light, then we're going to probably see that stock come in a little bit. I will say, back in February when we had a banking conference, J.P. Morgan came out and gave very good, very robust guidance for capital markets activities. Their investment banking guidance was a little bit light relative to expectations, but their trading guidance was ahead of expectations. And so people were generally pleased by that. The subtle difference is with investment banking, because you have a pipeline of deals, you have good sight as to what you can produce in terms of revenues. And so I put a lot more weight on the guidance for investment banking. And as I said, for JP Morgan, it was a little light relative to expectations in the market. Trading, on the other hand, where they actually projected much more robust revenues than the street was anticipating, you have no line of sight. You don't know what's going to happen. I mean, every day your P&L starts at zero. and you don't know what's going to happen in the markets, next quarter or the next month or the month after that. So that's where you could get your bigger surprises on the trading front.
Got it. All right. Well, we're going to circle back on hospitals if we have a couple minutes because we were talking before the show about that. I want to hit a few things in healthcare first. Basically, earnings season is done. A company Fortrea, FTRE, is getting hammered down 17% pre-market. I don't know where it is right now, but it's probably down 40% is my guess. But something, who knows? After a miss and a guidance miss below expectations, a friend of mine who was short last year covered because it was going against him. And he's like, I'm so stupid. I wrote back, just stop shorting. You'll be a happier person. And by the way, that is advice for most friends of mine who are miserable. But AbbVie today announced a move into the obesity space, and that's pretty interesting because they're going for an earlier stage product from Gubra in a $2.2 billion deal. Those are biotech dollars. There's a little bit upfront. Everything else is on approval and milestones. But what's good about that is Viking Therapeutics is down 6%, which I'm short. And I've said over and over on this show that the more times people do other deals away from the mainline products, the less chance that someone wants to pay Viking's huge market cap, plus all the development, plus all the facility build out. So as the stock comes down, does a takeout increase in likelihood? Marginally, yeah, because something's cheaper. So that's but I think now you've taken AbbVie out of the picture as an acquirer, so that's why it's down today. Some other specific things: a couple healthcare providers did provide kind of reaffirmed their guidance. Oscar, which I've owned off and on, OSCR, reaffirmed their guidance. It's up for like 3% or so. A couple other, there's a company called, well, I won't go into the penny stocks that are getting killed, but there is an interesting one that's like down 80%, but it's from $1. So, but let's talk about
David.
Yeah.
Can I just throw in there because on Friday you saw some very weak price action in the hospitals, and that just to put out some numbers, the S&P healthcare facility index was down 7.2% intraday, which is the biggest intraday drop since October 25th. Some of the names in that index were Acadia Healthcare, which was down 24%. They had poor earnings and EBITDA guidance. United Healthcare was down 11%. Tenet was down 10%. HCA was down 8%. The reason that those stocks in the hospitals in particular got hit is Politico had a report out on Friday that said that the Congress may limit federal match funding for Medicaid in order to help pay for their tax cuts. Now, that report was not surprising to me, and I think I sent you this document, David, but there's pay for the tax cuts. There are 23 mentions, 23 potential efforts where hospitals are going to be used as a source of savings, if you will, to help pay for these tax cuts. And so I think hospitals are very much a target of the Trump administration. And I think, this sell-off, whether it bounces today, I don't know, but it's probably not over with if Trump pursues all 23 of those policies.
It's interesting, especially since I always try to match up kind of what's happening in the culture with what's going on financially, if you can. And there was such a pushback in the Super Bowl ad from a hospital chain that and I want to say it was Montefiore, but I'm not sure, but I don't remember. But they did a full ad, and remember, hospitals are taxpayers' dollars. Like they're subsidized by the taxpayers, and when you see a Super Bowl ad, you just got to say, like, what are you thinking? So I'm not surprised that they're getting the scrutiny that they are, and you're right. You sent that long before the Super Bowl that's, the scrutiny's been happening since the new administration came in.
Yeah, this document actually came out January 20th, or around January 20th, not maybe. And I've been aware of this, and you say not to short, but I've been on the short side of some of these hospital names. So I'm
Well,
actually,
congrats on that. I don't follow my own advice on that. I'm just saying if you want to be happier, don't short. So I guess
well, I was pretty happy on Friday.
yeah, that's true. So, also in healthcare, we had a mixed thing. Novo Nordisk in the obesity space got a downgrade from Stiefel, and they got added to the Goldman Sachs conviction list. So you have a menu there. You can pick either side of that trade that you want. And then a couple healthcare conferences kicking off this week, Cow and Morgan Stanley. But I want to talk about something outside of healthcare for a second. I mentioned a few weeks ago that I'm long two gaming companies, Nintendo and Capcom. Well, Capcom had their launch of Monster Hunter Wilds, which you don't get to talk about hunting monsters too often on an investment vlog. So it came out last week. They had 1.4 million concurrent users on Steam, which is an online gaming platform. 1.4 million is the fifth highest ever recorded. This is a giant hit for them. Now, there's a lot of complaints about the quality of the game and the playability, which isn't surprising for most games. For most AAA games, like top games, this shouldn't be happening. So they have a patch that's coming out today and all the rest. But ignoring that, just from the sales standpoint and usability, all weekend it was at above 1 million concurrent users. And that's just on the Steam platform. So think of all the non-Steam users as well. So this is a huge hit for them. And it's a relatively small, relative to like Nintendo, relatively small company. So this is great for them. The stock was up 4% in Japan yesterday or today. And I think it's just going to continue. I think this is really good momentum for them. Whether it translates into huge earnings beats or just small earnings beats, I'm not so sure, but I'm kind of betting on the former rather than the latter. So yes, I do other things other than drugs. So I guess that came out the wrong way. But
yeah, I was going to say.
Any other questions? Any other points that we want to bring? I'm glad to see Robert. You're getting your OJ.
Getting my liquid sunshine out here in Florida. Yep.
Robert, when you mentioned Dell, is that such a unique story that it has no ramifications for other computer-related names, or is it in a space of its own, or does it have ramifications for other computer?
I mean, I don't know how to play it any other way, right? In the American stock market, so I don't really think of that as an angle to the story. I mean. It's what sort of Dell has is it has a bunch of different businesses, and some are getting an AI pull through, and some are supposedly going to get an AI pull through. And it's a competitive business. They make 4 to 5% net margins, and so a lot of the hardware business has been commoditized out of Southeast Asia, and that's where the competitors are. But we don't buy those stocks. And then they have a services business, and that's probably better than selling hardware, but it's not the best business in the world either. So it's not like the play on the computer business really has sort of been Nvidia, obviously, and if you think of servers and PCs. Nobody's making money in PCs, and some people make some money in servers selling to enterprises. So I don't think of Dell as having any tradable ramifications for any other companies in the stock market.
The reason I asked that question is I think this is going to be a year where stock pickers do better than momentum group rotation, and I'm seeing that in my own space. I can have a Citigroup that's up 20% year to date, and a U.S. Bancorp that's flat year to date. So
Mhm.
I think you do have to be a much more of a stock picker, which obviously is what Robert's really good at. So
Well,
all
we've been living with that for the last couple of years in semiconductors, especially where you had some semiconductor companies, even ex Nvidia, are up 100%, and others were down 30. I sold one before it went down 30 called ST Micro. So, I, I was very well aware of that. I am a technology investor. For much of the last 12 months, there was no reason for me to talk about it because it was the biggest momentum across the board momentum space in the stock market, in my opinion, in the first quarter and second quarter of last year. The tanking in various parts of the hardware and software business happened, over this, in the summer last year, and maybe gave you some opportunities to stock pick. But I didn't find anything I liked. So even though I'm a technology analyst and investor, you wouldn't know it by what I've talked about over the last year, because they were just everything was going up, and the news wasn't particularly great for a lot of them. So I just didn't have any way to participate. And, recently, a lot of stocks have sold off a lot more than the S&P, and that's where I'm trying to rifle shoot. I bought a defense stock that I had mentioned on the show last year, and taken about an 80% trade out of it. It went down 50%, so I'm back in it. So there's different levels of fundamental safety you could find when everything goes down. So I'm trying to buy starter positions in some of the companies that I think are not going to blow up, in because of the secular trends and the tailwinds. So I think Dell is, again, we're talking about 3 or 4% growth, accelerating to 7. This is not a 10. There was a lot of heavy breathing last year here on the show and other places about why this stock was a big stock and going to go up forever. And I just didn't buy it. I called bullshit on it, and it turned out to be right. The company is not a 10 or 15% grower, and people were saying it was going to get that kind of growth out of AI and PC refresh cycles. But I think the shareholders should be delighted with 7 or 8% growth out of Dell.
I think that it sounds like a nice, slow growth, super, super shareholder friendly company. But I guess if you have a CEO or chairman who owns so much, you're bound to get cash returned to you because it returns to him as well.
Yes. So that's it's a mature company now. They have grown up investor return policies, which many technology companies don't have. So it's not a bad place to. If this AI thing turns out to be bigger and better in the hardware business for both storage and for servers and for PCs, then they'll have a nice big tailwind that'll last a couple of years. And you never know, maybe at the top of it, they can get a market multiple. So, again, that's a $200 stock in a couple of years. I don't think it's a bad shot.
All right. Well, let's leave it at that. Trust me, there's so much more to talk about. If you are at all interested in investing, then you are doing things that Charlie, Robert, and I were doing this weekend: reading Ks, reading Qs, watching the Bitcoin price, wondering what a strategic reserve for Bitcoin would actually be, and will we include NFTs in that ridiculous idea? But that said, we have lots of opinions on that, but we'll have to hold that till tomorrow. If you want to have more of our opinions, or if you want to see some of our written work, just go to wallstreetbeats.com, subscribe, 14-day free trial, so you have zero risk there. And we'll see you tomorrow on Wall Street Beats. I'm David Maris for Robert and Charlie. Thanks for joining.